I want you to picture something for a moment. It is the worst day of your life. You have just lost your husband or your wife. And somewhere in the middle of the funeral arrangements, the phone calls, the paperwork that seems to multiply every hour, you have to walk into a bank and figure out what happens to the money you shared for maybe 30, 40, 50 years. Most people walk into that bank with no idea what to expect. And what happens next, whether the money transfers to you immediately or gets tied up in a legal process that takes months, whether you can access it that same afternoon or find yourself locked out of an account your name has been on for decades, depends entirely on 3 words that were written on the paperwork the day that account was opened. 3 words most couples never noticed, never asked about, and never thought would matter until the moment they matter more than almost anything else. That is what this video is about. By the time we are done, you are going to know exactly what those 3 words are and what they mean for your account specifically. You are going to know what transfers to you automatically and what does not. What the bank is going to ask you for and in what order. The exceptions that apply in certain states that can completely change the outcome. And the one step, a 15-minute conversation at your bank that costs nothing, that can make sure your own children never have to go through the uncertainty you may be facing right now. I also want to flag something I am saving for later in this video, because it is the one that shocks people the most and almost nobody warns them about in advance. Weeks after a spouse passes, some surviving spouses watch money disappear from the very account they thought was fully theirs, not because of fraud, not because of a bank error, because of a specific federal rule about Social Security payments that very few people know exists until it happens to them. I am going to explain exactly what that is, why it happens, and the one call that prevents it. So stay with me all the way through. My name is Nolan Carter. I track exactly this kind of thing, the rules and processes buried inside financial and legal systems that determine what actually happens to your money during the moments when clarity matters most and confusion costs the most. I am not selling anything today. I simply believe that if you are going to share an account with someone for 50 years, you deserve to know exactly what the law says happens to it the day one of you is gone. If this is the kind of information you want to make sure finds you again, take a moment right now and subscribe. This channel covers exactly this, the financial rules and protections that rarely get explained in plain language until it is already too late to act on them. Now let us start with the good news, because there is real good news here, and it is worth understanding clearly before we get into the parts that are more complicated. What right of survivorship actually means. Most joint bank accounts between spouses are set up with something called the right of survivorship. Those are the 3 words I mentioned at the start of this video. And if your account has them, here's what they mean in plain English. When one spouse dies, the surviving spouse automatically becomes the sole owner of everything in that account. Not eventually, not after a court process, not after a judge reviews anything. Automatically, the moment your spouse passes. The account does not become part of your spouse's estate. It does not go through probate, which is the court-supervised process that other assets often have to pass through before they can be transferred. And here's the part that surprises most people. Even if your spouse's will says something different about that money, the right of survivorship on the account overrides the will. The account transfers by operation of law, and no document your spouse signed afterward changes that. So what does this actually look like at the bank? You walk in with a certified copy of the death certificate, not a photocopy, a certified copy with an official seal from the County Vital Records Office or the funeral home. The bank takes that document, updates the account into your name alone, and in most cases, you continue using it without interruption. This is not an account freeze. It is a name change. The money was already jointly owned. The bank is simply updating their records to reflect that one owner is now gone. For the large majority of surviving spouses with a properly titled joint account, this process is straightforward and the funds remain accessible throughout. I want to flag one practical detail here that most people do not think about until they are already in the middle of it. You are going to need certified death certificates for far more than just the bank. Social Security will need one. Insurance companies will need one. Pension administrators will need one. The DMV, investment accounts, the mortgage servicer, if there is one. Order 8 to 10 certified copies from the funeral home or your county vital records office at the time of the death. It is far easier and less expensive to order them all at once than to go back and request additional copies weeks later when you are already managing everything else. Now here is where it gets more complicated, and this is the part that most coverage of this topic skips over entirely. When the right of survivorship does not apply. The first exception lives in 9 specific states, and if you are in any of them, the outcome can be significantly different from what I just described. If you live in Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin, your joint account may be titled as community property rather than as a joint account with right of survivorship, and that distinction changes everything. Under community property titling, only 50% of the account may automatically belong to you as the surviving spouse. The other 50% could be treated as part of your spouse's estate, meaning it may need to go through probate or be distributed according to the terms of the will rather than passing directly to you. Here is the problem. The titling on your account is not something most couples ever looked at closely. It was paperwork filled out at a bank branch, probably decades ago, and the specific words used on that paperwork determine which set of rules applies to you right now. If you are in one of those 9 states, do not assume you know which category your account falls into. Walk into your branch and ask this exact question. Is this account titled as joint tenants with right of survivorship or as community property? Get the answer in writing. If the account is community property and you want to change that, an estate attorney in your state can walk you through exactly what that process involves before you ever need it. And while you are having that conversation with your bank, ask about one more thing that applies regardless of which state you live in. Ask whether there are any accounts at that institution that are titled in your spouse's name alone, not jointly, solely in their name. Because those accounts do not transfer automatically under any of the rules we have covered. A solely owned account does not have a survivorship right. It becomes part of your spouse's estate and will typically need to go through the probate process or be transferred through whatever beneficiary designation was on file, if one exists. Knowing which accounts are joint and which are sole ownership before you need that information is one of the most useful things you can do with a single conversation at your bank today. The state estate tax question, the second exception, applies to a smaller group of families, but it carries real financial consequences for the ones it touches, and I want you to have the complete picture. In 2026, the federal estate tax exemption sits at $13.99 million. For the vast majority of American families, this means no federal estate tax applies to a joint account transfer at all. But here is what a lot of people do not know. Roughly 17 states plus Washington, D.C. have their own separate estate or inheritance taxes, and some of those state thresholds are dramatically lower than the federal one. In Massachusetts and Oregon, the threshold can be as low as $1 million. In Maryland, both an estate tax and a separate inheritance tax can apply. If you live in one of these states and your total combined assets, home equity, retirement accounts, investment accounts, and bank balances together approach that range, this is a conversation worth having with a tax professional, not something to estimate on your own. The funds in a joint account with right of survivorship are not subject to income tax when they transfer to you. You already had an ownership interest in that money, so receiving full ownership is not a taxable event. But any interest the account earns after the date of your spouse's death is yours going forward and is reportable on your tax return. That is a small detail that catches people off guard, mainly because nobody mentions it, and then a 1,099 arrives the following January showing interest income they did not expect. We have now covered how the right of survivorship works when everything goes smoothly, the community property exception that applies in 9 states, and the estate tax question that matters for a specific group of families. In the next section, I want to walk you through something that almost nobody warns surviving spouses about in advance, a federal rule about Social Security payments that can cause money to disappear from an account weeks after a spouse passes, and several other gaps in the process that create real problems for families who were not expecting them. The Social Security overpayment trap. This is the one I told you about at the very start of this video, and I want to spend real time on it because it is the one that blindsides surviving spouses more than almost anything else in this entire process. When a spouse passes away, Social Security must be notified as quickly as possible. In most cases, the funeral home handles this notification as part of their standard process, but confirm it directly rather than assuming it happened. Here is why the timing matters so much. Social Security pays benefits 1 month behind. The payment that arrives in your account in the first week of a given month is actually the benefit for the previous month, which means if your spouse passed away in the middle of a month, a Social Security payment may still arrive in your joint account days or even weeks after the death, and that payment, even though it landed in an account with your name on it, does not belong to you. Social Security is legally required to recover any payment made for a month in which the recipient did not survive the entire month. And here is the part that shocks people. The Social Security Administration can instruct your bank to return those funds directly without your permission and without advance notice. You may wake up one morning, weeks after your spouse has passed, and find that money gone from an account you believed was fully yours. The bank did not make an error. Your account was not hacked. A federal agency exercised a legal right to recover a payment, and your bank was required to comply. The way to protect yourself from being caught off guard by this is straightforward. When you notify Social Security of the death, ask the representative directly which payments need to be returned and what the timeline looks like. Get that information clearly before you make any spending decisions based on the account balance you see. And set aside whatever amount they identify rather than treating it as available funds. The surviving spouse is often also entitled to a one-time death benefit of $255 from Social Security, which you can claim during that same call. Ask about it specifically because it is not offered automatically. The safe deposit box problem. Here is another gap that creates real problems and almost never comes up until a family is already dealing with it. If you and your spouse held a joint safe deposit box at a bank, do not assume it will remain accessible after you notify the bank of the death. Some banks temporarily seal a joint safe deposit box upon receiving notice of death even when it was held jointly, particularly in states that require an inventory of the contents before access is restored. Documents, cash, jewelry, or original copies of important paperwork stored inside may be temporarily inaccessible at exactly the moment you need them most. If your estate documents, insurance policies, or the certified death certificates you just ordered are stored in that box, you may find yourself in a difficult position trying to access the very documents you need to begin the transfer process. Before this situation arises, make sure at least one set of critical documents, your will, your insurance policies, your account information, lives outside the safe deposit box in a location you can reach independently. A fireproof, home safe, or a secure digital backup are both reasonable options. The digital account gap. There is a category of accounts that an increasing number of seniors hold alongside their traditional bank accounts, and it is one that families frequently discover only after the fact. Online-only banks, high-yield savings accounts at fintech institutions, and balances held inside platforms like PayPal have different and sometimes significantly more complicated processes for death notification and fund transfer than a traditional bank branch. There is no local office to walk into. The process is handled entirely online or by phone with a customer service team that may not be equipped to handle estate situations efficiently. And because these accounts often do not appear on traditional bank statements, families sometimes do not discover them at all until months after the death when they are reviewing old emails or tax documents. The most useful thing you can do today, while this is on your mind, is create what is sometimes called a digital asset inventory. A simple written list of every account, every institution, every online platform where money is held, along with the login information or enough identifying detail for a family member to locate it. Keep that document with your estate papers in a place your trusted person knows about. It does not need to be elaborate. A single handwritten page updated once a year is enough to prevent a family from losing track of assets that are legitimately theirs. The automatic bill payment trap. One more practical gap worth naming before we move into the action steps, because it creates real problems in the weeks after a death that nobody anticipates. Most households today run a significant number of automatic payments through their bank accounts. Utility bills, insurance premiums, subscription services, mortgage payments. When a joint account is transferred into the surviving spouse's name alone, automatic payments that were set up under the deceased spouse's credentials, their login, their linked card number, or their email address, can begin to fail without warning. An insurance policy can lapse. A utility can generate a past due notice. A mortgage payment can miss a due date. None of it is intentional. It simply happens because the account update triggers a break in a payment chain that nobody thought to review. In the first week after the account transfer is complete, sit down and go through every automatic payment linked to that account. Identify which ones were set up under your spouse's credentials and update them one by one under your own. It is tedious, but it takes less than an afternoon, and it prevents a cascade of missed payments from creating secondary problems at an already difficult time. Now we have covered the right of survivorship, the community property exception, the state estate tax question, the Social Security overpayment trap, the safe deposit box problem, the digital account gap, and the automatic payment issue. In the next section, I want to bring all of this together into the specific steps to take in the first 30 days, the exact words to use at the bank, and the one 15-minute action you can take today that protects your own family from having to navigate any of this uncertainty when it is their turn. The first 30 days, what to do, and in what order. Everything we have covered so far, the right of survivorship, the community property exception, the Social Security overpayment trap, the safe deposit box, the digital accounts, the automatic payments, all of it leads to this. The specific steps to take in the first 30 days and the exact conversations to have at the bank so that nothing falls through the gaps at the moment when managing one more complicated process feels like the last thing you have the energy for. Start before anything else with the death certificates. Order 8 to 10 certified copies from the funeral home or your county vital records office at the time of the death, not photocopies. Certified copies with an official seal. You will need one for every bank where a joint account is held. You will need one for Social Security, one for each insurance company, one for pension administrators, one for investment accounts, one for the mortgage servicer if there is one for the DMV. Ordering them all at once is far less expensive and far less emotionally draining than going back weeks later to request additional copies while you are already managing everything else. Once you have the certified copies in hand, bring one to every bank where you and your spouse held a joint account. When you sit down with a representative, ask 2 specific questions in this order. First, can you confirm this account is titled as joint tenants with right of survivorship and not as community, property, or tenants in common? Second, what is the exact process to transfer this account into my name alone, and what is your timeline for completing it? Get both answers in writing before you leave the branch. If the representative is uncertain about the titling, ask to speak with someone in the estate or beneficiary services department, which most major banks have specifically for this purpose. While you are at that appointment, ask about every account at that institution, not just the one you came in about. Specifically ask whether any accounts are titled in your spouse's name alone. A solely owned account does not transfer automatically under the right of survivorship. It becomes part of your spouse's estate and will need to go through probate or be transferred through whatever beneficiary designation was on file. Discovering this at the bank while you are already there is far better than discovering it weeks later when you are trying to pay a bill. Adding a pod beneficiary, the 15-minute action that protects the next generation. Now here is the step that most surviving spouses skip entirely. And it is the one I want to make sure lands clearly because it is the one that protects your own family from going through exactly this same uncertainty when it is eventually their turn. Once your joint account has been transferred into your name alone, it no longer has the right of survivorship that protected it before. It is now a solely owned account. If something happens to you, that account does not automatically pass to anyone. It goes through probate, which in most states is a court-supervised process that can take months and in some cases longer, during which your family may have limited or no access to those funds. The fix is a form called a payable on death designation, commonly called a POD. It is available at virtually every bank and credit union in the country. It is almost always free to file. It takes approximately 15 minutes to complete. And what it does is name one or more people who will receive the funds in that account directly, without probate, without a court process, without delay, the moment you pass. The beneficiary you name does not have any access to the account during your lifetime. They cannot see the balance, make withdrawals, or make any decisions about the account. The designation only activates at death. Until then, the account is entirely yours. Here is the distinction worth understanding clearly, because it trips people up. POD applies to bank accounts and certificates of deposit. For investment accounts and brokerage accounts, the equivalent designation is called transfer on death, or TOD. Both work the same way, but they are separate designations that must be added separately to each account type. A surviving spouse who adds a POD to their checking account but forgets to add a TOD to their investment account has protected one and left the other exposed. When you visit the bank to transfer the joint account, ask at the same appointment to add a POD beneficiary to every bank account you hold at that institution. Then contact your investment or brokerage account separately and do the same with TOD designations. And here's the detail that catches families most often. Beneficiary designations on accounts always override the will. Always. A will that says leave everything to my daughter is overridden if the account's POD says son. A will updated last year is overridden by a beneficiary designation from 15 years ago that was never changed. After you have transferred the joint account and added your pod designations, do a complete audit of every account you hold and every beneficiary designation currently on file. Make sure every one of them reflects your actual current wishes, not a decision you made decades ago that may no longer match your family's situation. Reviewing your will after the transfer. One final step for this first 30-day window, and it is one that people consistently put off for too long after a spouse passes. A will that was written when there were two of you managing shared finances, shared accounts, and shared assets often needs meaningful revision once you are managing everything alone. Joint ownership structures that were doing the work of estate planning automatically are no longer in place. Accounts that passed automatically between spouses now need to pass somewhere else. Decisions that were made as a couple about who receives what may need to be revisited in light of how the assets actually stand today. Contact an estate planning attorney within the first 60 to 90 days after the account transfer is complete. Not necessarily to rewrite everything from scratch, but to sit down with someone who can look at your current asset picture, your current beneficiary designations, your current will, and tell you whether they still work together the way you intend or whether gaps have opened up that need to be addressed. That review is almost always less complicated and less expensive than people expect, and it is the one step that ensures the protection you put in place for yourself during your lifetime actually reaches the people you intend when it is eventually needed. Now let us bring everything in this video into a short, clear action list for this week and close out with the one thing I want you to do with this information beyond your own situation. Here is your action list. Work through these in order and do not let any of them sit longer than the first 30 days. First, order 8 to 10 certified death certificates immediately from the funeral home or your county vital records office. Order more than you think you need. Running out and having to request additional copies weeks later adds time and stress to a process that is already difficult enough. Second, contact Social Security as quickly as possible to report the death and ask directly which payments need to be returned and what the timeline looks like. Set aside whatever amount they identify before making any spending decisions based on the balance you see in the account. Ask about the one-time $255 death benefit during that same call, because it is not offered automatically. Third, bring a certified death certificate to every bank where you held a joint account. Ask the representative to confirm in writing that the account is titled with right of survivorship and to walk you through the transfer process and timeline. Ask at the same appointment about any accounts held solely in your spouse's name, because those do not transfer automatically and need to be handled separately. Fourth, if you live in one of the 9 community property states, Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin, do not assume you know how your account is titled. Ask the bank directly and confirm in writing before the transfer process begins. Fifth, once the account is transferred into your name alone, add a payable on death beneficiary to every bank account you hold at that institution during the same visit. Then contact your investment and brokerage account separately and add transfer on death designations there as well. Do not leave that appointment without completing this step, because it is the one most people intend to do later and never get back to. Sixth, do a complete audit of every beneficiary designation on every account you hold. Beneficiary designations always override the will. A designation from 15 years ago that was never updated overrides a will signed last year. Make sure every account reflects your actual current wishes before you leave this process behind. Seventh, check your safe deposit box situation with your bank. If it was jointly held, ask whether access will remain uninterrupted or whether any temporary restrictions apply in your state. Eighth, sit down and go through every automatic payment linked to the account within the first week after the transfer is complete. Identify which ones were set up under your spouse's credentials and update them one by one so that insurance policies, utility payments, and mortgage payments do not lapse silently during an already difficult time. Ninth, within 60 to 90 days, sit down with an estate planning attorney to review your will, your beneficiary designations, and your overall asset picture in light of how things actually stand now. This does not have to be a complete rewrite. It is a review that ensures the protection you have put in place still works the way you intend. One honest note before we close. Everything in this video is general education, not personal, legal, or financial advice. The rules around joint accounts, community property, estate taxes, and beneficiary designations vary by state and by individual circumstance. Always confirm your specific situation with your bank, an estate attorney, or a qualified professional before making decisions based on anything covered here. Now, here is what I want you to do with this. Think of one person you know who has recently lost a spouse, or whose spouse is seriously ill, or who has simply never had this conversation about what happens to a joint account. Not a general share. One specific person. Send them this video. The conversation we had today is the one nobody has with a surviving spouse until they are already standing at the bank counter confused and alone. You can be the reason someone you care about has the information they need before that moment arrives, rather than in the middle of it. Subscribe to this channel and turn on notifications so the next update finds you before it costs you anything. Thank you for watching. I will see you in the next one.